Hey, welcome to Strong Valley's Mid-Quarter Roundtable. This is actually our first time doing this, so the very first Mid-Quarter Roundtable. Thought we'd just kick it off real quick with where we're at here in 2022, and then talk a little bit about the questions we're getting from clients and things that are going on in the market. Two things basically driving the market. We drowned out the noise. The first thing is obviously inflation. Apparently, it wasn't as transitory as we had hoped or as had been told to us. Go back to econ class. Very definition of inflation is too much money chasing too few goods and services. So you stop supply chains. You inject money into the system. Not making a political call on whether that was the right decision or the wrong decision. Maybe the alternative was worse, but we'll never know. But we did add money to the system, and we stopped all of our production mechanisms and like I said, supply chain economics. So now here inflation is a couple of months later and into 22, it's as high as it's been in 40 years. So on that note, stocks react negatively to inflation. We have the Federal Reserve. Their main job outside of not crippling the economy is to keep inflation under control. So the Federal Reserve's had to step in and act. Some say a little bit too late, but they've started to raise rates, and the market understands that more rate hikes are coming. So you have the combination of inflation as well as interest rates raising, and that's driving where we're at here in mid-May 22.
Well, and specifically bonds. I mean, we've been talking for years about when interest rates go up, it's going to hurt bonds, right? And I have a chart here where we can look at it, but it's the worst start that we've seen in bonds really ever, according to BlackRock, ever. So it's been really rough, and the hard part about that, of course, for us as advisors is this is supposed to be safe money, right? We always frame it that way, and unfortunately, this year, stocks and bonds have price-wise have both gone the same direction. So I mean, like the theme with a lot of this stuff is going to be pretty simple. It's going to be it's rough right now, but it's probably somewhere down the road it'll get a lot better, and because that's been history. It's been recorded history. It always gets better. It's just not on our time, and because I think if everybody here would say we'd get to the better part right away, but yeah, with bonds being down so much, and equities being down so much too. I mean, it's been rough, and if you turn on really any bit of business news, I think we're going to dig into inflation and a few other things a little bit later, but it's been a really bad year for stocks too. I mean, another chart up here that this shows is through the end of April, third worst start for stocks, and so both of those combination, or that combination of the two, means that most of our client portfolios are down a lot more than I think we would have expected if we had this call, say, 6 months ago. So, but again, I mean, you guys know this, of course, but there's been a lot of the smaller names that have been beat up, going back into last year. And what we're seeing now, I think, is we're seeing the bigger names, the Apples, the Amazons, the Googles, the Ciscos today. You're seeing those guys sort of come through and get hit also. And nobody's going to be completely immune, but it's one of those things where, like in a lot of cases, you end up getting through the pain pretty quickly. Adam, what do you always say? It goes down quickly and it recovers slowly. So
yeah,
up the stairs, down the elevator.
Yeah,
a lot of that too, right. Chris, is kind of what you were saying before, and we were talking about in the office the other day. Is the hardest part about this market lately for us and conversations we're having with our clients has been the interest rate impact on bonds, and a lot of that usually is our safe money. And so it's harder conversations with clients that are sitting at maybe 60% equity, 40% equity, and their portfolios are doing similar to the client that may have 20% equity and 80% fixed income. And right. The slides you showed there that highlighted the worst year we've ever had in bonds highlights that they're down 9-10%. We've talked about clients with municipal bonds being down potentially 12 or 14% in just some muni markets. And so when we're having conversations and talk around with clients and the portfolios, and in the balanced approach. Jason, you were showing us a slide the other day when we were talking and having a conversation about, your average 60-40 portfolio is still down, similar to the ones that are high equity exposure. And that's what's made this market more difficult, I think, in conversations, a little bit more difficult the last 3 or 4 months.
Mm-hmm. It's been difficult for a lot of folks, and anyone who's scared, you're not having feelings that are unique. And so everyone feels this, that we're all in the same boat. The only people making money right now might have been the people betting for Armageddon, pouring all their money into certain commodities or things like that. But, we'll show you later that buying all the flood insurance in Vegas, it doesn't rarely pay off. And so most of us, 99% of us are in the same boat. I've got a slide up now that'll show the most common portfolio would be something like a 60-40, 60% stock, 40% fixed income. And that's how most people invested for a very long time. And so what you're looking right now is that it's very, very abnormal when stocks are down and bonds are down. Usually you've got one saving on the other day. If stocks are going down, people flee to safety and they're going to buy those bonds. And if they're wanting more risk, they might lighten up with their bonds and they're going to own stocks. And so quite often they're on opposite sides of the teeter-totter. But what we're all feeling right now is the teeter-totter feels like it broke at the middle. And it's definitely something that's abnormal. What you're looking at right now, if you can see it, is a chart showing back annual returns. Now, we're only about a halfway into the year, but the only year on record, and our numbers are going back in some cases 50 years. 2008 is really the only thing that's rivaling what we've got going on right now. And so really what we're trying to analyze right now is how much of the fear that all of us fear, given an Eastern European war, you've got fears of inflation, fears of rising interest rates, and then the fear of recession. How much of that is already baked into the cake? Mm-hmm. And my guess, and I think most of you would agree, that a lot of it is priced in, because usually once the fears start to subside, the market has already gone up considerably. And so what we're trying to analyze now is really how much of that fear is baked in. And history would tell us that by the time we are the most scared and we think things are only going to get darker or get worse, majority of the time the fear has been priced in.
So
go ahead.
I was just going to say, explain the recession. What exactly? I mean, the recession, you hear that on the news every day. Recession, and fear sells. We know that. We hear it all the time.
I mean, by definition, it's 2 consecutive quarters in a row with negative GDP growth, essentially the economy contracting versus growing. So you did hear, and that was a lot of the talk of the news lately with the last quarter was our first negative quarter of GDP in a while. And so the economy is shrinking. And a lot of that has to do with inflation, too few goods and available. And, one of the things that we talked about before was, the Fed put a bunch of money in the system. The government put a bunch of money in the system. And so consumer spending went up almost 14% for the first 4 months of this year. Whereas the supply side of it, the products was only up about 4%. And so when you have that sort of spread, that causes the inflation and the shrinking of the economy, I think. And so that would be the definition of a recession. But highlighting too, kind of what Jason was talking about, I have a slide right here that talks about that fear and that panic. And usually when we're kind of at the bottom of a market, this is going back, and those of you that can see the slide, going back to 1942, bull market versus bear market. In our world, think of the bull as, everything's good. Green market up 20%, bear market's negative. But in the middle there, you do have some recessions. And, things that I've shown clients and talked with and highlighted and all of you are aware of is that, recessions do happen over time, but they're usually not long lived. And a lot of times, as you can see by some of the gray areas here, when they have actually hit, the bottom of the market is already hit by the time we're in a recession, usually, or near the bottom. And that's because the markets have always been kind of leading indicators. And so, and I know that we'll talk about a little bit more on our thoughts of where things are headed in other areas. But, just because we've had, 1 quarter of negative GDP growth and, fear of a recession, the markets are usually telling us that when the pain threshold gets to the point where it's at, it's usually a pretty good sign that we're getting near a bottom. And you can see that the good times are usually a lot longer in duration than the bad times by the slide that's up with roughly, the average positive markets that go up over 4 years. And, the downside there with the bear markets are, under 1 year. And there really isn't one in history that was 2 full years. And so obviously it's favorable for the long-term investors.
Kyle, I think what you can also notice there on your chart is that, as we learn about recessions, we're told after the fact. There's no economic indicator that's ever going to tell you, our clients, that a recession is going to be here next month, a recession is going to be here next quarter. We find out the data about the GDP after it's already occurred. And
Correct.
as many of these cases that you've seen, I like to tell clients many times that the recessions are far more common than you might be aware. Over the last 140 years, I think we've had 20. So the average is every 7. And the duration of these recessions, I think, isn't more than 2 years on average, or even less than that. By the time where the market is bottom and we're out of it and beyond. And by the time that we often figure out that we had a recession, the market bottom is already behind us. And so trying to be preemptive or market time and get around it and get ahead of it, by the time you actually find out that we had a recession, the market's usually bottomed behind you.
Well, there's a economist named Samuelson that I think he said something like the stock market is, predicted 9 out of the last 5 recessions. It's something like that. I mean, that's to your point, Kyle, about the leading indicator. It is a leading indicator. I mean, the market, is a lot smarter than we sometimes give it credit for, whatever it is. And but sometimes it's a head fake. I mean, we've had these type of drops many, many, many times over the last, let's say, 20, 25 years, and not to be followed by a recession. Because even the term recession is so technical. If you have negative economic growth for 4 months, that's not technically a recession. So you can't count that. I mean, it still feels like it. And when folks open up their statements, it really feels like it. And that's that wealth effect, you might even argue led to a lot of the big spending numbers that have been coming in over the last few quarters. You feel like, hey, the value of my house is up. Maybe a total amount of debt or money that I owe people is down, and people are willing to spend, and you compound that with the fact that people have been, for the most part, locked up for going on a couple of years now, or at least have felt like it. We have clients that want to travel and do things and go see family, and they have not been able to do it for whatever reason. Maybe the country that they want to go to is locked down, or the state that they go to, or even the family. You have somebody that's really, really sensitive to COVID in this case, or whatever the case may be. And people, there's still a lot of pent up demand for getting out and doing things. So I saw some statistic the other day about concert ticket sales, like it hit record, not total concerts held or anything like that, but total concerts tickets have been sold is off the charts in terms of the fourth quarter. So I think we're going to get into doing a lot of that other stuff, and whether or not earnings are up or down for, some of these big companies is, in some cases, not going to affect very much in terms of our client behavior. They're still going to go. So
for sure. Yeah. I think a lot of the things we're saying are, you got to be careful. Fear sells. You got to be careful of the Permabears, we call them, the permanent bears, and they're out there. People make predictions all the time, just like Chris was saying about, this is going to be bad, this is going down. I mean, even when COVID started, all the predictions were outlandish compared to what it really turned into. So the data, the historical data just doesn't bear out that, the predictions that get made, that it's always going down and it's always going to be negative. So the Permabears, like I said, they get on TV a lot, but don't reflect what's actually happened in history. So
we all know too, Adam, how many times you've heard the client say, well, I saw someone on TV and they said the market's going to go down another 20%.
Yeah.
I kind of take these guys.
That person never comes back on when it doesn't go down 20%. They
also don't have any money.
Go down. Yeah, and what do we always say, right? If you keep predicting that the market's going to go down, eventually you're going to be right. It's the old broken clock. Right. Like, it's right twice a day. Eventually you're going to be right, but it doesn't mean that over time that's going to be the way to make money. So. I think one of the things we want to talk about is, so what are the top questions you're getting from clients? I mean, these are things that, maybe one client's asking, but there's probably a lot of other people thinking the same thing. So best question from each of you, or at least one of you to start.
Yeah, I'll take one here. The one thing that I know we all get is, how much lower could this go? I mean, even some of the people that are so unbelievably scared, we even get some of the questions like, I mean, could this just all go to zero? Are we just gambling with our money? Could this just all go to nowhere? And I'm gonna pull up a couple of these, but then I think Adam would be wise to explain. We discussed about marketable securities, and I think that might explain it for a minute. But when I've got some folks that are really truly scared about everything from the possibilities of depression or World War III, or just can't see tomorrow, I try to explain to them, could everything go to zero? I guess if we want to split that fork in the road, theoretically it could. And here's what would have to happen: either complete global nuclear holocaust or meteor, meaning that you're gone. And if we're all gone from this earth, whatever afterlife you might believe in, I'm sure you're not going to be worried about your Schwab account. And so if we go down the other side of the road, we would have to look at it in order for everything really to go to zero and not return. Every company that you see on this screen right now, which are the largest companies in the United States, from Apple to Google, Johnson & Johnson, Exxon, Procter & Gamble, JP Morgan, Visa, Chevron, MasterCard. I mean, we can go on and on and on. Every single one of these companies have to go bankrupt on the same day.
What is this list? Is this the S&P 500?
These are the top holdings within the S&P 500. So This is basically what makes up, quote, quote, the stock market that you see on the news each day. Mm-hmm. And so yeah, they're feeling some pressure. They might have gone up a little bit too much last year. Now they're coming back down a little bit more this year. But Adam, explain for this, if you would, why this is so relevant and why people worry about this, whereas they're not so worried about the painting hanging in their house or the value of their home in general, or a car or an old
I think
coin.
It's important to understand what we do and what we invest in and why it's valuable. So what we do, although people think of stocks and bonds traditionally, we invest in marketable securities. And by definition, the definition of marketable security is there's a market made. In other words, the price of that security, and you can turn that security into cash within a very short time window, a day or two, at any given time. So you own a share of Apple anywhere in the world, what the value of that security is daily. And so all the investments we have for clients are marketable securities, like Jason mentioned, different from a piece of real estate, your personal residence, your art collection, your jewelry, on and on and on. I mean, lots of different types of investments. You could be doing other types of investments where they're not hard, like first trust deeds, where you have a deed on a property, or where you've made a loan sharking, basically is what you're doing in an organized fashion. But those aren't marketable. So you go to sell your house, everyone's familiar with that. You got to find a buyer. There's no market made for that. You don't know what the value of your house is every day. You got to go find a buyer, and then you got to turn it to cash, and that takes time. If you got a nice piece of jewelry, you really don't know what the value is. You know what you paid for it. You know what the value is today, and if you need to turn it to cash, then you got to find a buyer. And typically, the other thing that is not mentioned,
we call that getting a bid, right? You got to get a bid.
Got to get a bid. And the other thing that's not mentioned is it costs you. I mean, what it costs you to sell your house. I mean, 4, 5, 6% to sell your house. Marketable securities in our world doesn't cost you anything to turn it to cash. So that's the real value. But the downside is the same thing. They're marketable. So the value every day, and you watch the value. And even though you may not want to sell your house, if you watch the value of it go down every day as real estate prices depressed, that might get you pretty worried. If you paid $400 and it's worth $300, 6 months later, that might panic you, but you just don't see it the same way you see marketable securities. Because in order for our stuff to be able to be turned to cash, you got to have a value constantly, at least daily. So,
and that leads to the panic too, right? I mean, all the clients are constantly seeing the marketable securities price all day. They turn on the TV and it's the red across the screen, and the sensation of panic, market crashes, market tanks, and you're seeing the flashing constant red screen. You don't see that on a house or a car or jewelry. You don't see what your house is worth by the minute or by the hour or by the day. And so I think that goes to the marketable security part, that when it's daily and readily available, it stays front and center more than the physical assets that may not get priced constantly.
So the biggest value, and I should have, I kind of beat around the bush on it, but it's liquidity. Mm-hmm. Liquidity is your greatest value in what we do and why we have clients' assets, because people want to be invested, they want to make money, they want to reach their financial goals, but at the same time, you don't know what's around the corner. I mean, lives change, things change. We've all had clients that had a certain plan, and something happened, whether it was tragic or in a positive way. Things change, and so we value liquidity. And again, that's your whole marketable security advantage, but it's also a disadvantage.
Well, and that goes hand in hand with, like you mentioned, planning. I mean, that's really the basis of what we do. So some clients we know are built for longer runs, where maybe they can have more aggressive investments, and some need a lot of their money in a shorter time frame. So those two clients that I just described are going to be invested completely differently. Wouldn't you say, Kyle?
100%. I mean, we've always talked about in this office and with clients a lot is that, you try to have money that's set aside, whatever your time frame is. If you're retiring today, tomorrow, or in 20 years, clients live a lot longer than they did before, right? So, I mean, it's not like you work to 62 and you die at 70 usually with a pension. It's you have to have a plan in place, and that's a lot of what we do is building those plans. But part of that is also making sure that, the money that you're using today is money that's less at risk, meaning that it's in the fixed income or cash, even, 6 months, 8 months worth of reserve cash for your spending, while the money that's later in retirement is more at risk and, trying to grow to offset that, that purchasing power, that gets depreciated with inflation. So 100%. Yeah. It's usually changes how we invest things for the short term as well as for the long term and for each client.
I want to piggyback that real quick, Kyle, because one thing, the common question we get too is is it different this time? And when it comes to the financial planning, and then, I would urge my clients speak to me, your clients speak to you, because the one thing that I want to remind everybody is that within the goals, within the financial plans that we create, what you're going through right now, we didn't know what headline would cause it, but we were familiar with the drawdowns, and those are absolutely expected. In the screen that I've got up right now, what I try to explain to clients quite often is how normal this is, albeit the headline might be different, but humans react the same. We get excited when we get excited, we get fearful, we get greedy. Those emotions have been around as long as we've been around. And so what you're looking at right now, these are annual drawdown returns. And so this data here is going back almost 100 years. And this data is what feeds our financial planning. And so the stock market never goes up 365 days a year. It corrects every single year, and it is corrected 100 years in a row. Every single year it's had a correction, and that average correction is right around 13%. And so we've gone a little bit beyond that now. But I wouldn't say what we're going through right now is really abnormal. There's been many other times before that it's corrected worse, but the story really behind the story here is that even though the market has had a correction 100 years in a row, the depth of that correction every single year is, give or take, mid-teens. The market has still had a compound average, 7, 8, 9% that has got people to their goals. And so when we do financial planning in the simulations and the algorithms that are running within the plan, it's expecting this. The one thing that it can't predict, though, and there's no disclaimer at the bottom of our financial plans that say your future is entirely dependent upon your monthly market timing, because then all the algorithms get thrown off. And so what we are factoring in, though, are corrections every year. What we can't figure in is if we get in, get out, get in, get out, get in, get out, because then the giant disclaimer is going to be your entire retirement future is based upon your ability to guess. And whatever CNBC analyst you might have seen on that day got you out, and whoever got you back in, that's what makes the predictions much harder, and that's what can really disrupt the plan. But I just want to kind of make the point that we plan for this, that we expect this. We just don't know what will cause it.
Well, that's similar to a slide I got up here too that I show quite a bit in meetings here with clients, Jason, but it not just the declines that we experience, but in the frequency, but it also doesn't necessarily dictate where things are going to finish the year either, right? And so if you go back, this slide goes back to 1980, and the orange on it is essentially the drawdowns intra-year. And then the top side of it is where the year finishes. I mean, obviously years like 2008, we were down, 49%. And where did we finish? Yeah, down 38. It doesn't mean everything always comes back. But there's a lot of times, you look at 2009, we were down 28% at one point, finished up 23. 2020, our most recent, right? With March there, with the lockdowns and COVID and market drops 34%, we finished the year up 16, excuse me. So again, that doesn't mean necessarily that it's going to come back today or tomorrow. But it does show that, these are very common and built into our software and our financial planning. And as you said, the one thing that it can't predict or, is and account for is emotion, right? And I know that we've talked about that. Adam and I were the other day, we're talking about, possibilities versus probabilities, and, having to be right twice on the way in and out. And a lot of the conversations we've had with clients in that, right, Adam?
Yeah,
well,
for sure.
With that, Adam, how do you and Chris get the old? I mean, we all get the question. Why don't I just? This won't stop going down. It feels like it won't stop going down. Why don't I just go to cash and kind of sidestep this for a little bit and then go back when I feel better? Or at least when things have settled down, when the market stabilized, when et cetera, et cetera, et cetera.
Yeah.
We've all thought it.
One of the things I try to do, I mean, I'm a total numbers person, and I mean, all this data is great, but sometimes people are, you think emotionally, and I try to explain that, a lot of things in our life are linear, or at least we anticipate, and it's, perfect example, like crossing the street. I mean, if you can't anticipate, you're dead before you make it very far, right? You look at the car, you see how far it is away, you see how fast it's going, and can I get across the street anticipating that, hey, I know where it's going to be at a certain point in time? I mean, these are simple decisions we make every day. The other one is, just kids hitting a baseball. I mean, ball relieves the pitcher's hand. You don't wait until it gets to the plate to swing. You have to anticipate where it's going to be. The problem is they do, clients, people in general, our human nature is to do the same thing with markets. Well, I'm down 5% this month. That's 10% next month. That's 60% over the course of the year. I'm going to be out of money in a year and a half. Yeah, I'm going to be out of money. And so it's a tough sell. They don't understand that multiple things are already priced in, and markets can change directions quickly. You just because, again, it's the old slide that I don't have, but everyone's seen it, that the average return of the market, it's almost never been hit. There's very few times where the average return of the market is the actual return in any given year. It's
either a lot higher or a lot lower.
A lot higher, a lot lower. I mean, everybody thinks
that's how you get to the average.
Yeah, if I'm going to average 5, I probably will hit 6 some years and 4 some years. It's positive 20 and it's -8, and all the things in between, they get you to that average. So that's one of the things we talk about. And then I think like Kyle mentioned a little bit, 2 right calls. I mean, pure math. You got to get out and you got to get back in. Flip a coin once, that's a 50% chance. You got to get it right 2 times in a row. That's a 25% chance. And, probability tells you that you're in the market. And I think there's a slide on that I don't have up at the moment. But, I mean, the longer you're in the market, better chance to make money. So
the going to cash thing too, though, I mean, what's so difficult about it is it puts you almost in a frozen kind of position, a frozen feeling. And I've had clients feel this before and have been in it, because it's very easy to hit the sell button.
Yeah.
It's very easy to hit the sell button. Just get out. You just stop the pain. Everything just now feels good. You feel happy. But we all know with inflation where it's at, that being in a cash position for the rest of your life isn't a plan also. So now you've just put yourself in a position to get back in. And so now the conversations I've had with clients have gone both ways. They've actually been right. The market's gone lower a little bit. They're thinking, okay, I can buy back. So I called the client up. Congratulations. You called it perfect. Let's get back in. Well, I don't want to get back in now. It's only going to get worse. I was right. Down. This thing is just going to keep going down and down and down. I'm not touching this thing with a 10-foot pole. Or vice versa. The market goes up. Hey, you win some, you lose some. Let's not make a small problem bigger. Let's start nibbling back in. No. I still know this thing's a piece of junk. I know it's going to go lower. I'm going to wait this thing out a little bit more. Market goes up higher. All right, let's really not make this problem worse. Well, yeah, maybe I had a missed call there, but I don't want to buy the exact same stuff and pay more for it for what I sold. So I'm just going to wait for the market to correct back to where I got out. Years later, they're still in cash. And so once you go to a cash position, the hardest thing is to get back, because you usually don't like the market no matter what it does. If it goes up, you don't want to pay more for what you got out of. And if it goes down, you think it's only going to get worse. So you end up just sitting on your hands for years. And that's a really difficult position to be in.
Going to cash is a perfect example of something that feels good in the short term, doesn't work out in the long term. But it feels good. Like you said, it ends the pain and you're out, but you never get back in, or you don't get back in at the right time because, as you just explained, and it ends up costing you money in the long run. So, yeah, just Chris always says his thing to clients is just how much higher do you want the market to be before you get back in?
Right.
And
they don't always. Well, that's emotion, right? I mean, again, the same fear and emotion that drives you to reach that position where you want to go to cash you need the reverse of that to get back in. And what makes you feel good? Markets are going up.
Green.
And
You
so
want green.
So it's
Euphoria.
usually the sell low, buy high, and that's not usually a good recipe. So.
Well, just investing by emotion, it gets tough too, right? You're selling to end the pain, and then you don't want to start investing, like you said, until you feel better. And what do all of us need to feel better? You need green markets, and not just one. You need a lot of them.
Yeah. So we answered, is the market going to collapse? Is it going to go to zero? No, probably not. We'll just said, hey, probably shouldn't go to cash, and that's not the right. What should clients be doing? This is the one we get a lot. Like, what should I be doing? And are you doing anything? Because we have discretion over client accounts, so we're obviously managing portfolios. So what should I be doing? What are we doing?
I'll take that first. One thing that I've been doing just to calm the volatility, going through the portfolios, meeting with clients, seeing if they need cash, parking some things on the side so that way if things are choppy and volatile, we don't have to liquidate securities potentially at a temporary low. That's one thing. Possibly increasing some of the quality of the stuff that we've got in there. I know all of us are managing our fixed income portfolios, trying to reduce either duration or risk or things like that. But, it's not a matter of market timing. I think what most of us are doing is kind of managing the minutia. And then the one thing that I know we're all doing is just revisiting with the clients and showing them that the plan is all still on track. Even though we've had all this crazy volatility, nothing in there 10, 20, 30, 40, 50 year targets have really been altered at all.
Yeah, along those lines too, like a lot of times it's hard for clients and for us, right? I mean, a lot of times people want to do something just to do it, right? Like things are down. What are we going to do? We have to fix this. And as we kind of highlighted earlier, both fixed income and equities are down. And so sometimes the best course of action is to make sure we're reviewing with our clients, like we all do with our financial plans, and making sure that we're aware that, hey, this was baked into it. But at the same time, if this experience that we're going through right now is too painful, it will end. And when it does, that's when we need to revisit the portfolio and maybe, take some more risk off the table and not at the bottom. And that's at least some of the conversation I've been having with clients that allow this market to recover. And when it does, if this was painful or too painful, or you're 10 years older than you were when 2008 hit, and you don't want to go through it, okay, maybe now is the time to revisit that plan and take some of that risk off the table, but not when things are so, beaten up right now. So
that's good.
Well, we all eat our own cooking too. When we're all saving, the four of us are all saving for retirement. So what are we doing in our 401k? Buying systematically, just like just like we tell clients to do. What are we doing in taxable accounts? Looking to see if we can take tax losses and use those for future gains. So those are the basics. You the old adage is stick to your knitting, right? You keep your discipline, you keep doing what you're supposed to do, you stay invested, and you make little changes when the right time appears. And so, again, not to speak all in adages, but if you like something at $50, how can you not love it at 40? Right?
I try to remind the clients
really good companies. These are really, really good companies that sometimes the market just says, these guys are no good. Oh, really? All they do is sell things and make money. That's there's some really, really good businesses that have been absolutely hit just at the beginning of this year, really, really hard. And so, it's easy if you got a ton of cash and you can go shopping. It's, that's a nice thing to be able to do. But, the discipline of rebalancing and, again, tax loss swaps and systematic investing is, we look back in 18 months, this is probably going to be a pretty good opportunity for a lot of people to put cash to work.
Well, history would suggest the same. Every time the market has had a correction north of, a correction ever. The market's made all-time highs last year. And so every time someone got jumped out, every time, it ended up being the wrong decision. Yeah. And so what I'm trying to remind people too, I understand the frustration for people that are fully retired and don't have more cash, more income, more savings to take in. I get their pain. I know what they're going through, and that's why their portfolios are often more conservative. But for the folks that aren't retired, the story I'm trying to convey is mathematically, I know this doesn't feel good emotionally, but mathematically, this is probably perfect, and you should actually hope for it to go lower. If anyone is planning on adding to the retirement account this year or next year, we think about this. I feel like our markets are the only markets that people run away on the sale. Every other product that you ever want to own, you run to the sale. Ours is usually treated the opposite. And so, I gave a story to a friend of mine that understands real estate a lot better than this. And I said, imagine you had the dreams of owning 5 rentals. That was your goal. I want 5 rentals, but you already own 1. You got 4 more to target, let's say, over the next few years or 5 years or whatever. I said, mathematically, what is the best possible thing that can happen to you, to the real estate market? He said, oh God, I hope it crashes. I go, yeah, but what about that 1 you already own? Well, who cares? Now I can go buy those 4 more that I want. The mentality is identical to our market. So if you're targeting a retirement date of 5, 10, 15, 20 years down the road, and you've got a part of your portfolio already saved, but you've got a lot more that you want to add to, I mean, mathematically, this is going to help you.
Jason mentioned earlier one thing to note. What should we be doing? We call it the Armageddon portfolio. It's basically, my screen's up there. You can share it, but it's the things that do well when the markets don't do well. And this is, a good example of why you don't create portfolios for bad markets. I mean, all of our clients are what we would consider a long-term investor, which is at least a couple of year period, if not more. Most of them are more.
What are we looking at, Adam?
Oh, sorry. So the green is the S&P 500 over the last 10 years.
Can you make it a little bit bigger?
I can. Yeah, I can't zoom like Jason because I'm not a mad zoomer, but.
Yeah, that's better.
All right, I see you've got what do you got? Treasury bonds, gold, and commodities.
Yeah, Treasury bonds obviously haven't done that well this year, but typically that's something that does well in a down market because people run to safe assets. Commodities have been awful over the last 15 years, but they're up 30% this year. They're one of the only things that is up. And then you have gold, and everybody, gold always comes up. Hey, I should buy gold. Gold's the answer. And not that any of these are bad investments, but this is a 10-year period. And you can see -5, -4, up 16. That's not per year. That's over 10 years. You have 16% more money after 10 years than you did 10 years ago. Or you had the S&P 500, just a basket of U.S. stocks, and you're up, 204%? Mm-hmm. So not that you should only have, basket of U.S. stocks, but don't create portfolios for the things that do well in negative environments. So this is, every now and then you get the client that's like, why don't we just have
components? Yeah, you want to have those as components as part of a diversified portfolio, but
not the only thing.
Yeah, but not exactly.
But not the only thing. For the always planning, being in the bunker every day of the year usually isn't profitable.
One of the other things that kind of brings up too, when you're talking about Armageddon portfolios, Adam, is I know that we were having a conversation the other day about it, is usually when things are really bad, like, markets are down, is when we get more calls and conversations around insurance, right? Annuities. How many times when things are down do people want to convert to an annuity to protect that downfall? And what are some of the ththings that you're telling those clients and having in regards to, that panic and liquidating to put everything in an annuity at the bottom?
Yeah, just generally, we try to really simplify things for clients and help them think about things they understand. Like insurance, we tell them insurance is for insurance. You're hoping not to use it. So when you buy insurance on your car or insurance on your house or insurance on your life, you're hoping not to use it. That's the idea. So annuities are to protect something. If anything, an annuity has to make sense for multiple reasons, which it usually doesn't for our clients. But if it did, you would want to do it when the market was at its peak, right? We don't know when that is, but let's just say you got to a certain number and you were like, hey, this is what I need. I want to guarantee it. There'd be other conversations around that, but at least there's some protection there. The exact opposite time to go to annuities, any type of annuity, even look at an annuity, is when the market is down. You're paying for insurance to protect
the lowest level,
the losses you've already incurred. I mean, that's getting hit by the train and then jumping out of the way. It doesn't make any sense. So the other thing we explain about annuities is I always use this, basic kind of a triangle, and clients really understand return. Obviously, everyone wants to make money, and they do understand risk. No one wants to lose it. And what kind of risk am I taking? But like we talked about with the marketable securities, they don't understand liquidity. And so we always say, hey, you could pick risk, return, liquidity. There's a triangle, and you can go anywhere on the edge. So you can pick 2 of them, but you can't have the third. So if you want to have risk and return, that's your standard, marketable security investments, your stocks, your ETFs, your mutual funds. If you want annuities, you're basically giving up liquidity. Okay, so you've given up your liquidity, you locked in the downside, and you have some upside, but you have no ability to move out of that. If you don't want any risk and you want liquidity and some return, that's cash. Right now, those returns are low, so you can kind of move anywhere on that triangle. But the one that clients we found over many years often discount is liquidity, and I think that's one of the reasons we value it most for clients because had a guy come in the other day that $500,000 into annuity, had a great plan, didn't think he needed the money. I didn't sell him the annuity, by the way. It was somebody else. And then something happened. Had an accident, hurt his elbow, had to have surgery, out of work, and things change. And the annuity said money is locked up. He's pre-retirement age. You got surrender charges. You got early retirement withdrawal penalties. Just all kinds of negative things, and I felt bad that it happened to him. But it's a perfect example of why the annuity often makes sense, but you don't understand. You don't think about the downsides, and you give up a lot of liquidity.
Well, it has to be the perfect fit. That's one of those things that has to be the perfect fit. It has to be the perfect replacement for pension money that might be coming in. You have a rollover out of a big retirement plan, and you need specified income, right? You need guaranteed income, or you need somebody to back the income number. It's got to be perfect, and there's just not very many situations where it is perfect. And a lot of people, again, Kyle, to your point, a lot of people in situations like this, they go, well, what's the perfect answer? And they're looking for protection, and it's kind of like calling your insurance guy after you have the flood. It's not a good time to try to buy flood insurance. You got to set it up beforehand when your house is really, really valuable.
And along those lines, I mean, obviously, clients do own annuities, right? It's not something that we completely exclude, and it may make sense for parts of money or some of your money or for certain reasons. Like you said, the perfect example, Chris, is creating that pension like income, right? And so some of the income generating annuities make sense, but that's not when people are calling right now for those, right? The calls we're getting for annuities are because of the fire sale, right? It's the fire insurance after the fire already happened. And usually that's the type of annuity that gets sold a lot right now, that can do a lot of disservice to clients by like you said, Adam, removing that liquidity from their portfolios and locking something up for 7, 8, 10 years at a time when things have already kind of near the bottom there. So
and often at we've seen the last many years, often at really low interest rates. You lock yourself into a 3% return for 10 years, and I mean, you look back at that and go, oh, that sounds weird, but it happens regularly.
Well, the irony, though, if you think about it, because most of them have that 7 to 10 year lockup, if you ask the same client, do you think the financial markets will be lower than where they are today a decade from now? Most of the same clients would agree that they probably won't be. The times in history that markets have been flat over a full decade, I think occur once. Other than that, the likelihood of making money over that long a time, you've got a 95% probability, I think is the number. So really what they're doing is, going back to Adam's point, they're removing the marketability of it, so that way they don't have to see the number anymore.
Or liquidity.
Market,
right. See the value.
That way they're not getting berated in the face with what the markets are doing. It's like, okay, I just feel better. But really what they're doing is they're taking a diversified portfolio. If that's why they're doing is buying it just straight out of fear, they're buying a diversified portfolio. But they're going to have the same timeline as if they just said, okay, I'm going to take this other diversified portfolio and just kind of leave it alone for a decade.
Exactly. So you got to understand what you're doing. If you get an annuity and it's variable annuity and you're still invested in the market, you basically just paid more for insurance that you probably won't need. If you're like Jason said, if you believe the market's going to go up and you're going to be invested in the market, but you want downside protection, you're just paying more. And that's the issue with really any investment, anything in life, right? It's trade-offs. I say this all the time. You're trading one thing for another thing. You have to know what you're giving up. If you get something, if you get a certain product like an annuity, you get some benefits to that, but you also have some downside. And a lot of times, my issue isn't so much with the product for the perfect fit, is that the people that sell them typically only tell you the positives, which sounds really great. And then you don't know the negatives. You don't know the trade-offs. And so, I mean, our job, on this side in the RIA world is not to sell products. Our job is to help clients. So if the annuity is a great fit, yeah, we absolutely will look at it and possibly implement it for the client. But it's not a product sale. It's not something that we have to sell annuities. We're here to manage portfolios and manage financial lives. So,
right.
What else on one of the other things that we're getting, I think is relevant. We talked about it a little bit in the 22 recap, is bonds, and people understanding why their bonds are down, especially high quality bonds and in munis. So, I want to speak to a little bit on why bonds would be down right now, and more specifically the risks involved in bonds. You guys want me to take that one?
No, I'll take a little stab at it here too. Just kind of what we've been seeing is it goes back to like we talked about at the very beginning with inflation, right? And so one of the things that the Fed is trying to do to kind of help combat the inflation is rise interest rates, right? And so when we look at fixed income investments, there's an inverse relationship between interest rates and essentially principal value, right? So as the Fed raises interest rates, you got to, I kind of tell clients example of, if two people are going to, borrow money from you, one's going to give you 2% and one's going to give you 4%. The only reason why you would go with a person that's only going to give you 2% is if, you got it at a discount, right? On the principal side. And so that's kind of what happens when new bonds and new that are coming to market are giving, say, 4% and existing bonds are at 2%. You get that inverse relationship where the principal or the price of the existing bonds go down. And so that's why we see the performance that we're seeing on the drawdown on the principal side of the fixed income. And so that's something we've talked about. I know, at least with our clients, and I'm sure we've had conversations. So I'm sure you guys have all had the same conversation with your clients for the last couple of years that, we don't know when interest rates are going to start to go up, but they are. And they can't go below zero, and so eventually when that happens, we are going to have this short-term, poor performance in bonds. But kind of like that slide that we were talking about before, that I got right here is, historically, when we do have these poor performances, as we mentioned here, 2022 has been the worst start ever. We don't know what the next 8 months are going to look like, or the next 12 months are going to look like for the fixed income world. But, history shows these are essentially the top 10, starts that I have up here on this slide, and every one with the exception of 2021, which is carryover from current, right? So if you look back the last 12 months, that's 2021. But every other period, they've bounced back in every environment, and so that's just, I think that's kind of the reason we're seeing a lot of the price pullback in bonds, and two, the marketable security part that we were talking about too, Adam, as far as bonds have to have a bid and they have to have an ask, and so the only way that somebody's going to be buying those existing bonds that are paying less interest than upcoming bonds is at a discount. And so I think that's kind of what we're seeing here, and the harder conversations we mentioned with clients is even municipals, which in history have been kind of more of our safer assets next to treasuries, and we've seen municipal bonds down anywhere from 10 to 16% for the year, which is hard conversations too. So,
Kyle, I think one disconnect, at least one confusion that I hear from clients when it comes to interest rates, they'll say, well, yeah, but isn't the government going to raise rates more? Okay. And then won't that make my bonds go down more? And the point that I make back is what we don't know, or at least what I believe, is how much of that expectation is already priced in. And so what I explain to the clients is that with the Federal Reserve, when they raise interest rates, they are not raising rates that are directly affecting your bonds. Correct. Or directly affecting mortgages, or directly affecting that. All of that is the market, air quotes. And so they're actually affecting just the prime rate, the borrowing between banks. Everything else is driven by the market, by investors buying and selling. And so where we saw that firsthand, and this is why it caught many investors, I'll say myself included, is that the speed of rise caught most people off guard. We all kind of thought it would be a gradual runway to start off this year. And so even though the Federal Reserve in March raised rates just 1/4 of a point, we saw the 10-year Treasury nearly double or go up 100%. I don't remember what the low on the 10-year was, like
at least up in yield, you're saying.
Up in yield, correct. So what was the 10-year at? What in around the start of the year, November, December, I want to say the 10-year yield was like around a 1.50, something like that.
1.516, and it went up to 3. So essentially double. Yeah.
And so what that's telling us, and what it would tell an investor, is that, okay, you're not alone in believing that the government is going to raise rates. Jerome Powell, the Federal Reserve Chair, has telegraphed it, that they are going to do some kind of rising rates And we just don't know how much over what duration, but the market has priced in so much of that already that as long as, so when he ended up raising rates a half a point just here recently, the 10-year treasury, which is the one that's pegged to mortgages and a lot of the bonds that we own and things like that, it didn't even move. It stayed perfectly flat because it was so expected. So now when they meet again, it's expected again. So there's many people that I believe to be wise that think the 10-year treasury, which again is what pegs off so much of this, it may kind of hover around flat because the Federal Reserve has telegraphed so much of what they're already going to do. So a lot of that got priced in the first quarter, hence why your slide shows the worst start to the bond market ever.
Right.
And so that's why I want to kind of convey to clients that even though the government may continue to raise rates, it doesn't necessarily mean that bonds would continue to erode because, again, a lot of that pain's there.
That goes
priced in, right? Markets are leading indicators, right?
Yeah, so that goes back to that. Oh, sorry. That goes back to that nonlinear thing. You know, again, the markets aren't waiting for everything to happen and then reacting. It's already priced in, and so you know, like you said, that may be the reason for the worst start because they already anticipate it. The other thing we like to mention with bonds is you know, interest rate risk versus credit spread risk. And I have a slide up right now that I mean, credit spreads have not blown out at all. In fact, hopefully you can see that. Zoom in a little bit, but the important part is that basically credit spreads and across all these asset classes.
Adam, if you would explain a credit spread.
Credit spread, the what you're paying to or what you're getting paid to take on risk. So when credit spreads blow out, you're getting paid a lot more to take on risk. That's the fear side. That's the down market side. The interest rate risk is obviously what we've talked about with rates moving up and then making bonds that are, you know, if you got a 2% bond and rates are now at 4%, well, then your 2% bond's got to be worth less to be the equivalent. So credit spreads have not had an issue at all. It's been purely interest rate driven risk. And again, going back to the whole mark to market thing, one of the things that Kyle talked about was, hey, your bond's down, but in the future, that bonds have permanence. You know, you loan somebody in a bond $10,000 for 10 years. You're getting back $10,000 in 10 years if it doesn't default. So the credit spread is your default risk. The interest rate is your, you know, obviously is your market rate risk with regards to rates. So all purely interest rate driven at this point. And so we got that mark to market phenomenon where bonds are down, but they're still a long-term investment. And they're still, you know, just as safe as when we started. In fact, munis are the second safest asset class in the world. I think most people understand that munis are safe, but they don't understand the degree. The only thing better is U.S. Treasuries who've never defaulted. I think the muni default rate is somewhere around less than 0.1%.
You know, along those lines too, Adam, as you talked about, you know, depending on how you're getting your exposure to, you know, the fixed income world, you know, you talked about individual issue bonds, and we, you know, have some of our higher net worth clients that we buy individual bonds for in their muni portfolios or even corporates. And I said the point there is, like you said, is knowing that if you do hold that bond, there is a maturity date, and assuming that the bond is good and the company behind it is good or the municipality is good behind it, you will get that principal back, right? And in the meantime, you collect the income or the interest on it. But the other side of it is when we get the exposure through, you know, mutual funds or ETFs. Again, those are pools of bonds or inside of there. And so I always tell clients too that, you know, the principal gets beaten up with the rising interest rate like we've seen, but the benefit is that over time that yield on that portfolio is going to go up. Actually the income, not just the yield. And that's because, right, now that mutual fund has the ability to buy new bonds coming to market at higher rates. Mm-hmm, and so pulling that money, you're getting those new bonds in there. And so, you know, in our world, sometimes people talk about yield, right? And it's yielding more now. Well, yeah, it's because you lost 10% in principal. So it's a higher yield. But this is an opportunity when interest rates go up for those mutual funds and ETFs to add bonds to the portfolio that are actually paying that higher interest. So not just your yield, but your income can go up over time. While that in turn, usually the principal does recover in those funds as well. So,
yeah. What about let's move off bonds. I think we hit that. What about your what if client? I think we all have these and maybe questions we haven't answered, but what if this happens? What if this happens? What if this happens? Typically low probability items, but you know, well, what if?
Trying to think of some of the better ones.
Well, I know what we tell them. I mean, we tell them very specifically that, there's probabilities and there's possibilities, and we invest for probabilities. It doesn't have to be, 100% probability or 90% probability, but, I typically throw out something like, there is a possibility that aliens land on the planet tomorrow and take over. There's a possibility we get hit by a meteor, but it's not probable. In fact, it's very, very, very low probability. And this goes back to the Armageddon portfolio. You can't invest for things that are possible. You have to invest for probabilities. So that kind of typically answers a lot of the, well, what if this happens? Because it could. It absolutely could. And
spoken like a math guy.
Yeah, I mean, it could happen. It's just not likely.
Well, that's kind of like what you said too before with the Armageddon scenario is if that extreme low, almost impossible thing happened, the last thing you're going to worry about is what your Schwab account's doing or your portfolio is doing. We're going to have a lot bigger problems in this world if that's the case than just, how much money do I have left, and can you even spend it or get to it if that was the case? And so those are so low and so far out there that it goes to, it's just not likely. And there's the bigger issues at that point. And then goes back to what you talked about too with your Armageddon portfolio. I mean, if you're investing for that, then you're not truly investing. You're building a protection around something that eventually when interest rates go, our inflation is high as like it is, sitting in cash loses money too. Right. And so it's one of those things,
especially this year.
Yeah. 8%. So
yeah.
Yeah. And I think we had one of those recently with, a little bit closer to home that obviously had a little bit more legs to it with Russia and Ukraine. And, right away, is this going to be World War III? Is, the world going to destroy itself? I just think we often take our possibilities, the possibilities seem more like probabilities, and the probabilities, we don't take serious enough and seem like possibilities, kind of like the market. And we've seen all the data and the direction that it probably will go, but then people will be concerned about losing all their money. But then the things that are possible, we put a lot of weight into. So it's definitely something we talk to clients about.
I can remember vividly a conversation that I had with a client when she was, almost visibly fearful, of this is when Russia first went into Ukraine, and what if? I think we all had that kind of fear in the back of our head.
Sure.
And it's still there because they're still at war. And so the conversation that we were having, obviously we can't measure out the probability of things, escalating, but really how much of a financial impact is that on us? And she said, I think we should sell everything because of the threat of war, or because Russia is now in Ukraine. I said, well, let's back up from this minute and take a look at the investments and see what we're in. And I said, let me kind of explain this in a way that I think we all can understand. And I know a way that you can understand too. So we're not analyzing specific stocks. I said, let's look at it this way. I said, I want you to pull up your credit card statement from last month. This was the month prior to Russia going into Ukraine. And so she runs everything through the same card. She was looking at, everywhere she shopped, the bills that she has on auto pay, everything from her phone bill, Costco, Starbucks, gasoline, everything that she was paying for. And I said, okay, now I said, let's wait. Let's check back in 30 days. So now that Russia has been in Ukraine for a month at the time of this conversation, I said, now I want you to pull up your most recent statement. I go, tell me everything that you canceled. She's like, well, I didn't change anything with my spending. I said, that's exactly my point. I said, the companies that you own inside of your portfolio are benefiting from that spending. I said, as terrible as it is on a human level, on a humanitarian level, on what's going on in Eastern Europe, the lines at Costco here have not changed. And that's where I think she got it. Even though the current price on what someone else might pay for that stock at this exact same second is going to fluctuate just with general global fear, the earnings of these companies and stuff that we spend money on, not a lot has to happen for this system to keep working. Really the way that I kind of explain to folks is that as long as a good portion of this population goes to work, there's really only 5 things that they can put their money in when they earn money. If they don't want to spend their entire paycheck the day that they get it, and they want to save it for tomorrow, next year, retirement, whatever, they've got like 5 things. They can keep it in cash. They can put it in gold, precious, buy real estate, stocks, bonds. That's pretty much it. And so as long as people are going to need to hoard money for the future, they've got basically 5 options. Crypto and paintings and things like that will make up a small percentage.
We're not getting into crypto.
But the majority of they don't have
maybe next call.
Next call. Many options.
A lot of time.
And as long as people want to go to work, they want to eat, they want shelter, they want to make lives for their children, a better life for their children, they want to travel, they want nice things, they're going to go to work and they're going to need somewhere to put that money. And so at the end of the day, if Costco, if I already mentioned that, is down at the moment, how many of our clients really believe that Costco may not survive Christmas? And
Right.
but that's the way that we're talking right now. And that's the way those conversations are, is it's very difficult to see the light at the end of the tunnel.
When you see that same panic in, the recent movement in Walmart and Target the last couple of days with, their earnings and how, 25% down for Walmart in a day, it's like, I'm pretty sure Walmart's not going anywhere. Right. But that fear and that rationale and it impacts and people react. And that's what we see with the depression in the prices. But kind of like you said, that's not the Armageddon scenario that's likely.
Yeah. Yeah. And I'm not sure where you guys want to take it from here, but I got a couple of things that might actually be optimistic to this call. One thing that I've got here, I mean, it's a sentiment chart. So it's showing you how scared and how pessimistic everyone is, which historically is actually a sign of optimism. And so, not calling a bottom here. I mean, we have no idea.
Maybe opportunity, not so much optimism, but opportunity for sure.
Yeah. Absolutely. And so what this chart is showing everybody is this is going back 30 years, and it's showing you all the low points of when people have been the most scared. Basically, this is a chart of how many people think things are going to be better in the near future, and the levels right now are the lowest they've been since the great financial crisis. And so if you think about where we were in a country with the subprime meltdown and real estate down 30% and unemployment north of 10, and everything was just companies going bankrupt and automotive companies going bankrupt and everything that was as bad as it was in the financial crisis, people losing their jobs left and right.
Mm-hmm.
The current fear right now rivals that. And so that usually when people are as scared as they are, it's a sign that we're close. And so then to piggyback that, the other chart that I've got is actually showing where people are sitting on cash in their savings accounts, their investment accounts, that people
this is a good one.
So scared that they're hoarding cash, they're raising cash, they're selling their stocks, they're selling their bonds. The whole, I'm just going to go to cash and wait till I feel better.
High correlation with the other chart.
That's right. That's
Inverse
right.
there.
So our cash levels in this country right now on the average investor are the highest they've been since .com.
Well, and this was specifically, I think, is showing, money manager cash allocations, right? So you have a lot of mutual funds, separate accounts that are sitting on a lot of cash, and those are institutional investors. I don't know if I have the chart of what deposits are at, banks and cash they're actually held at institutions that are not in investment portfolios. This is like abnormally high, cash allocations, but yeah, it's a massive number right now. And that's the thing, at some point, we feel right now like fear is sort of guiding everything, and there'll be a point where it switches back and it'll be greed time again, and prices will rip. I mean, it happens over and over and over.
Yeah.
Those that will probably be more fun.
And that kind of goes towards too, getting things a little bit maybe more optimistic as, what do we see out there that could be a catalyst for things to kind of turn around and go? And I'll start off by just a few things that I've kind of noticed too. But, Chris, you hit at it right there. Is cash on the sidelines is still extremely high, both at the institutional level and even investor level. And so what happens is that's, to me, is like fuel next to the fire, right? It can only sit there so long before it goes back in and ignites and kind of is that catalyst for growth when things are depressed, right? Because there's people with a shopping list that are ready to buy when they feel things have bottomed, and there's a lot of cash to drive those markets back up. The other side is too, corporate earnings, 70% of the companies so far that have reported the first quarter earnings are still been positive. Now, future and forecast growth levels may be less than what people wanted to
see.
Kyle,
positive meaning positive over
quarter over quarter.
Yes.
Yeah, exactly.
Not just that they made money, but that they're making record amounts of money.
Growth, 100%. Yes.
Yeah.
And so, but that's the thing. And maybe they're forecasted for the next quarter or the year might be lower than what the analyst wanted to see. These companies are still profitable and are still making money. And so that to me are two things that on top of, I still think there's the I don't know what the word I want to use is, but it's coming out of the COVID and that, tendency for people to want to go do things again. Right. And that desire to travel, like we talked about earlier, and spend that money, I think are all things that could potentially fuel this market to kind of turn around and will be there to be positive once it kind of does bottom out.
Yeah. And like you were talking about earlier, negative earnings growth is the difference between a company making $100 million profit in a year and only making a $99 million profit. That's you you're technically down over the last time you reported, but you're still making a lot of money.
Still
I remember
positive,
when Amazon crashed because they only made 110 billion and everyone thought they'd make 111.
Yeah.
They still made 110 billion dollars in a quarter of revenue.
It's unbelievable.
So one other question that we get that we didn't hit on is, what about the people who maybe are coming up on retirement? They feel like they have less time, because I know a lot of times people will talk to us about, well, I don't have 10 years. I'm planning on retiring in 2 years, and just conversations you're having around that.
Yeah, I'll go for that. It's the way that I kind of describe it too is, even if I've got a client that's going to retire next year or the year after, what I try to remind them is, I said, look, you're going to retire in a year or two, but you're not going to be dead in a year or two. And so when we design these portfolios,
hopefully,
when we design these portfolios, I mean, it's really designed the fact that, okay, we've got moments of what we look at as liquidity in the account. So a diversified portfolio, you're going to have short-term investments and long-term investments. And so you might be, if you need cash dispersed over the next 12, 14, 18, 24 months, 2 years, et cetera, that's going to normally pull from stuff that is far safer, either your short-term bonds, cash, things like that don't need to wait for a recovery. There's a very good chance that if you're retiring at 65, that you might very well be alive for 3 decades. If we look at where the stock market was 10 years ago, 20 years ago, let alone 30 years ago, the portion of the money that you're feeling the most pain on today, it's quite likely that you're actually not going to touch that money for 15 years or longer. And so that's where I try to hammer home to a lot of our folks. And that's what's built into the financial planning. That's why the planning.
I was just going to say that the plan counts for that, right?
Well, and that's why when you see, even though the market has corrected, 15+%, the long-term projection of the financial plan probably hasn't even moved 0.5 millimeter. It's just because that's entirely normal. And we know that when we're going to take disbursements off the account, we're taking from the stuff that hasn't gone down for the most part, or at least not gone down that much.
Yep.
And so the stuff that needs to recover and will recover, we're probably not going to be touching that money for many, many years down the road.
And I'll kind of piggyback that too, Adam, is on the planning side, is in clients that are near retirement, hopefully they have had the opportunity to kind of develop and focus on a plan, and that's built into it. Because a lot of the things that we discuss with clients and even new prospects or clients that are coming in is what are those short-term and long-term goals. And short-term for the 40-year-old may be, a wedding for a kid, or, whatever that may be, that's an expenditure. Or short-term for the client that's 65 is, where's my income going to come for the next, couple of years. And so building a plan as well as a portfolio around that plan to say that, like you said, Jason, there's short-term aspects and long-term aspects to that portfolio. And with 20, 30 years in retirement, I mean, I go back, look at 2008, the market went from, 15,000 to 8,000, and where we're at, near 30,000. So, there's those fluctuations and drops, but the money that's invested for the long term, we plan for this volatility, and usually, staying the course is where you actually grow your accounts and achieve those goals.
Kyle, imagine if your client retired in 2007 and put all their money in the market the day before the financial crisis of 08. Mm-hmm. Left alone, they'd be more than doubled, and they're now just in their 70s. And so that's kind of the story where I was going. So in those first years of retirement, they're going through the financial crisis. Well, then they leave their stocks alone. They're living off the cash, living off the bonds. Go ahead.
The plan's important too, because it gets them away from, I mean, believe it or not, almost nobody really wants to beat the market. But if they don't know, if they don't have any idea of what they're supposed to be doing, those are the kind of things that come out of their mouth. Like, well, I want to make a certain % return. I want to beat the market. And the truth is, the market is not going to get you the things you want in your life. It's getting goals and figuring out what level of risk you need to take, and what amount of, what amount of assets you need to get the income you want in retirement and do the things you want to do. In most of our clients' cases, they've obviously done well, and they've saved money, and it's time to enjoy some of those things, some of their bucket list items that they want to do. So the market performance, like Jason mentioned to you earlier, typically doesn't detract from that, because it's already built in, and it gives them a focus on what they're really investing for versus, beating the S&P or having half the risk of the S&P, whatever. Those aren't real goals for people.
And those are usually the ones that want the market level returns with a lot less risk.
Yeah, I want something really nice, but I want to pay nothing for it.
Right. Or I don't want it to fluctuate either. Just
right, and I don't want it to move at all.
Yeah.
So let's talk about, we kind of talked about a lot of questions and given some answers. It's been really good. Where do you guys see it? Obviously, no one has a crystal ball, right? We don't know for sure, but where do you see things going? And this is, again, another client question we can kind of wrap up with. Where do you see things going by year end? Maybe a little bit beyond year end. We don't know an exact date, but kind of what are the things you're looking for as the year progresses?
I'm actually thinking that, maybe I'm just a general optimist, but I'm thinking a lot of the pain. If I had to put a number on it, hold my feet to the fire, I'm going to say 80 north +% of the pain feels like it's priced in. So as long, I've tried to explain to folks before, news can still be bad and markets go up. As long as they're as bad as expected or even less bad than expected, news can still be bad. I try to explain to clients that the lowest day of 2020 in the stock market, the lowest day when we went through COVID, was actually the exact same day that the United States had its first reported death. And that's when the market bottomed. And so every single day from that day forward, people continue to die and people continue to get sick, but the market went up. Why? Because it wasn't Ebola. It was less bad, even though it was terrible. And so when I'm looking at right now, when we're looking at the probability of World War III versus possibility, pray to God that it's going to be less, but odds are it will be. Inflation probably isn't going to be 20%, like some people fear. And it's quite possible. I think the first spike to this market could be when inflation is under the estimate. And then I think the Federal Reserve may not have to raise rates quite as hard as a lot of people fear, because a lot of the markets itself have kind of controlled the demand and controlled some of this inflation, because people are just so scared. So they're not spending as much money, or if their financial assets are down, they're not spending as much money. So I think it's very possible that the markets are higher than where they are by year end compared to where they are now. And especially bonds. I think you'll get those yields that we're seeing on the bonds right now are starting to get very attractive, especially for long-term investors.
I think too, like you said there, Jason, as far as, your fear baked in and people stop spending, right? So we've had clients and conversations with people, that are fearful. And so maybe they aren't spending a lot as much. And so, like you said, some of the things we're looking for is inflation to kind of come down. It's not going to go from 8 to 2% overnight, right? But just kind of the less increase.
But it doesn't even need to. If it just goes from 8 to 7, people are going to,
100%.
Market's going to go to the moon if it goes from 8 to 7.
And that's a market
less bad.
And that's a market fix in itself, right? And by people spending less money, it allows the product and supply chain to kind of build back up, because there's less spending and less demand for it. And so I think over time, I agree that I won't ever predict and say that we've hit bottom by any means, but I'm in the same camp that I feel like most of the pain is behind us, and the market has already kind of priced in a lot of the negative stuff that we're talking about might happen in the next month or two. The market's forward looking, as we talked about. So I'm not willing to go out on a limb and say the market's going to be positive by the year end, but I do think that we've neared bottom, and I think that the portfolios will be higher at the end of the year than they are today.
Are we going to have to answer the same question on the next mid-quarter call and see if we're right or wrong?
We may. I guess that's part of it, right?
I'm glad you said that, though, Kyle, because most of what we deal with as an entire economy is self-correcting. And when you talk about, people are a little fearful, portfolios are down, maybe housing prices are starting to slow down their growth, then and then folks start slowing their spending, and then there's not as long of lines at the grocery store, and suddenly prices are able to come down a little bit. When there's so many people, Adam mentioned this earlier, when there's so many people and so many dollars chasing so few goods, if you can just abate that a little bit, prices start to settle themselves, inflation comes in, checks in lower, and then you have a situation where suddenly, like you said, maybe the Fed doesn't have to raise all the way through the end of the year. Maybe they don't have to keep cranking it in. And so some of these things will self-correct themselves, I really believe, as well.
Yeah, I think that's good. We'll probably close with that. Just wanted to thank everybody for taking their time to be on here. I think we went through a lot of good topics. Hopefully questions that maybe you have that we're having conversations with other clients about. You get a view into how we think about things, and like I said, the way we're answering various questions we're getting from other people. But I think maybe the biggest takeaway is this is a private client business. Everybody's in a unique situation. We talked about a lot of different situations here. People that are in retirement, pre-retirement, younger, need money, don't need money, more risk, less risk. And the uniqueness of what we do is working with people individually. We can't control the market. couldn't control where it's gone in the beginning of 22 and won't be able to control where it goes the rest of 22 and beyond. But we can analyze your situation and set it up most advantageous for you. So give us a call if you have personal questions. Otherwise, we'll try to do this more often and hope you enjoyed it.
Thanks, guys.
See ya.
Thanks, everybody.
All right.